Okay, so let's go back up to section 4. The cross-sectional dispersion and expected returns and momentum profits. So section A, weighted relative strength strategies. And so to begin, we'll remember that CK argued that the difference in momentum profits is due to the cross-sectional variation and not the time series variation. So here the authors are going to reconcile the difference between CK's findings and findings in this paper. And specifically, they find that their empirical tests overestimate the contribution of cross-sectional differences and mean returns to momentum profits. So first we're going to look at the simple decomposition that was performed by CK. And so under this strategy they used the WRSS, the weighted relative strength strategy, whereas the Jegadeesh and Titman portfolios were equal weighted instead of being weighted according to the proportion of their returns over the previous period. And so with this formula we see that the weight that's given to each stock in the sample period is equal to the stock's actual return over the ranking period minus the average return across all of the stocks in the ranking period, and then divided by the number of stocks in the sample. And so since this is the difference in return minus the average return, in total, all the stocks weightings together is going to equal 0, because some of the stocks will have performed better than the average and some of them will have performed worse than the average, and across all of them they will equal the return average. So based on these weighting schemes, then the return of this strategy will equal this. So it's basically the sum of the returns of all of the stocks multiplied by their weight, which was the same formula here. So by building the portfolios this way, the difference between what was done before and what's done in the WRSS is portfolios built before were on all of the securities were equally weighted. However, here the largest winners get the largest weights, and the extreme losers also get an extremely small weight and less dramatic weights to the less extreme winners and losers. And in practice, the portfolios are probably more likely to be more like the equally weighted portfolios that were researched before. But giving larger weights to the more extreme winners and losers allows us to explore this phenomenon a little closer. And so Table 6 reports the results of forming the portfolios in the WRSS way. So let's go down to Table 6. And so we can see the strategy here. The WRSS strategy earned 0.379% average monthly over the period 65 to 97. We also have here the variance of sample mean returns, which is 0.00509, which is actually 134% of the profit figure. So let's go back up to the discussion and dig a little deeper into what these figures mean. And so now we can decompose the WRSS profit equation into an expected return and an unexpected return piece. And so the profit of the strategy, when combining it with this equation we had up here, or making it in a similar form, is that the variance of expected returns plus the unexpected piece, which is just the serial correlation piece, and you can see how it's taking the sum of all of the covariances of the unexpected return compared at time t compared to the return at a time one period prior to calculate the serial correlation. And so the thought here is that if the momentum stocks are selected based on conditional expected returns, then this part of the equation will be higher when the expected returns are higher, and so then that excess return should carry forward indefinitely. And so the importance of this is that a lot of the other prior studies find this unexpected piece, the serial correlation piece, to be the important part of this equation, because that would mean the behavioral pieces of the theory would be true, where the returns of the stock go up for a period of time and then down for another period. However, the CK study finds that the expected return piece is the more prominent and can be used almost to fully explain the return. And so then that would mean that the behavioral part of prior studies is not true. And so in their study, to estimate this expected return figure, CK used the average realized return of each stock as their measure of the stock's expected return. So the equation would be this, which is basically the sum of all of the returns divided by the number of observations to get an average. And in doing so, if you remember from table 6, the cross-sectional variance of this return was 134% of the WRSS profit. And so since the cross-sectional variance of this term was over 134% per table 6, it suggests that maybe the entire momentum profit is due to the cross-sectional differences and the expected return. However, the authors find here that the variance of the sample returns overestimate that dispersion and the true expected returns. So let's see how they come to that conclusion. So first we have this term, which was the unconditional expected return of stock I, and we've added in an error term to result in the total expected return of stock I. And so since we're not biased with the total return, then we expect the errors to be 0. However, since the total variance equals the variance of the expected plus the variance of the error, the variance of the estimated expected returns overestimates the cross-sectional variance of the true expected returns. And so this is even worse because the stocks in the population could be fairly new and therefore a lot more volatile and imprecise in the expected returns. So now we're going to see the extent to which this measurement error and the sample mean could bias the estimates of dispersion and the true expected return. So figure 3 takes a look at this, so let's go down to figure 3. So this here is the distribution of the annual mean returns for the stocks over the 65 to 97 period. And these are annual returns. So I think they have these titles in the wrong place. I think percentage of firms should be up here and return range should be down here. And if that's the case, we could see that about 50% of the returns are between 0 and 20% per year. However, there's a pretty big variation here. There's a small percentage that earn less than 80% per year, and some that earn over 100% per year. And if you add all of these up, about 20% of the stocks in the sample size earn negative returns. And so since this dispersion is so wide, it really biases the CK estimate upwards and makes it look like the cross-sectional variance is what is causing the momentum return. Okay, so let's go back up to section 4B. Direct tests of risk hypothesis. So up to now, we've been using the CK method to examine whether cross-sectional differences in expected returns can explain the momentum profits. However, it's kind of tough to use their method for a number of reasons. So we're going to take the approach in a different direction. And so if you remember from Table 4, we used the CAPM model and Fama-French three-factor models to risk adjust the returns. So now we're going to use that with CK's assumption that expected returns are constant over time. And so using CK's approach, we can use the sample average returns as the unbiased estimate of expected returns, as we used in equation 3 above. And so the authors computed the average returns for each firm over 3 different sample periods. So the first measure is the ex-ante sample mean computed over the pre-ranking period. And that equation is as so. Okay, so what this equation does, this term, as you remember, is the expected return. So the pre-ranking period would be the period from the time that first stock returns are available after January 1963 all the way up to 6 months prior to the formation date. And so you can see this T term here is the first date the stock prices are available for that particular stock, and the summation goes all the way up to T minus 6. So here we have all of the returns summed for all of that period divided by basically the number of months over that period to get an average. But the issue is that something could have happened in the 6-month formation period that would change the risk of the stocks to make it to where the expected returns will have changed by the time of the formation date. So to counter that, an equation was made which calculates the average returns after the 12-month holding period. So you see the beginning of the return calculation is 13 months after the formation date and goes all the way to the end of when returns are stop being available, and sums that up and divides it by the number of months over that period. So then they combine these two time periods into an equation to find the average return over the pre-ranking period and the post-holding period. And so basically the abnormal return would be the stock's actual return minus the expected return, which we expect to be the average over this period. So Table 6 presents the abnormal momentum profits, which is this figure. So let's go see what is at Table 6. Actually, I think they meant to put Table 7. Yes, they did. So here's the table that describes the abnormal profits. So here we see that the holding period profits exceeded the pre-ranking period profits by 1.3% per month, which is a bit higher than was estimated in prior sections. Also in the post-holding period, the actual returns exceeded by 1.08% per month, and averaging the pre-ranking and the post-holding periods, the actual returns exceeded by 1.28% per month. So we could say that since the momentum profits in the holding period were this much more than the average pre and post the holding period and ranking period, then we could say that the momentum profits aren't due to expected returns when we're using past and post returns as the expected return. Okay, so let's go back up to section 4C for a little more discussion. So basically, CK experiment scrambled all of the monthly returns for each stock and randomly drew one of the months with replacement in order to kind of randomly observe a distribution of the stock's returns. And in that way, it would eliminate the risk of serial correlation because the stock's returns now aren't in order of time. And so they did this calculation 500 times, and the results are presented in Table 8. So let's go look at Table 8. And so here we have the previously calculated WRSS profits of 0.38% per month. That was found to be statistically significant. And here we have the simulation with replacement done by CK, which earned 0.41% with a very significant T statistic. And then without replacement, the WRSS profits were negligible. And could probably be say as zero based on the T statistic. So the CK argument is that if the actual profits are the same as the simulation, then these momentum profits actually earned are actually just random. However, with the with replacement simulation, there's a flaw, the authors say, because if a selected stock return month is selected for the formation, the ranking period, it also has the potential to be selected in the holding period, and in that instance, for instance, very big winners in the ranking period would have higher weights in the portfolio, and then would also have, since it was selected in the holding period as well, it would have that same high return in the holding period and make it appear that the momentum profits were random. And so that tiny difference really makes their argument to be flawed. So now looking at the without replacement, we see that the WRSS profits were not that different from zero. So that would mean that the excess momentum profits would not be due to the cross-sectional variation and expected returns as CK had suggested. Okay, so let's go back up and sum this up and conclude on what all this means. And so what we've done throughout this paper is we looked at various explanations for why the momentum profits occur, the profits that were first established by Jegadeesh and Titman back in '93, and we also looked at an out-of-sample period from I think 90 to 97 period, or 89 to 97 period, and that period was found to be about the same as what was found in Jegadeesh and Titman's prior paper. And so we could conclude that it's not merely just a data mining result. And to find out more about the reason for why the momentum profits occur, we looked at this post-holding period. And in doing so, we combated the CK theory that the momentum profits are due to time series variation in returns and cross-sectional variation. And this would mean that the post-holding period returns should be significantly positive and in line with the momentum profits. But what's really found to occur is that the post-holding period holds negative returns for momentum portfolios. So we looked a little farther out, 5 years out, to see what occurs with the return. And we found that after the first year and through the 5th year, the returns are substantially negative, and most of the time wipe out all of the momentum profits that were earned in the first year. And this will support the behavioral models that found that momentum profits are generated by delayed overreaction. However, it's interesting that the return reversal does not occur significantly until years 4 and 5. And since it's tough to evaluate the behavioral models, but it is clear that the results are very different from CK's hypothesis that the momentum profits arise from cross-sectional differences in the expected returns rather than the time series predictability. So the authors replicated the studies made by CK, and particularly the scrambling process that was shown to eliminate or to generate the same returns as the momentum returns using replacement. However, digging deeper, it was found that the with replacement scrambling could be biased to include months of stock returns in the holding period and in the formation period, skewing the momentum profits and making them appear like they were random. However, in this paper, it was tested to see what would happen without replacement scrambling, and it was found the average returns in that process were not different from zero. So what this means is the momentum profits observed in the actual data is generated because of time series properties of stock returns, not because of cross-sectional variation in returns.